Welcome back and congratulations on making it to part 3 of our Infinite Banking Masterclass. You've made it further than 99% of agents ever do. My name is Josh Morin with Infinite Financial, and in this final segment, we're going to move from theory into action. By now, you understand the mechanics of participating whole life insurance. You've learned how to design a properly structured policy for maximum efficiency and long-term growth. But the question remains, what do you actually do with it? Because a perfectly structured policy doesn't create wealth by itself. It's the application that brings it to life. It's infinite banking concepts. Infinite banking concepts is not just a policy, it's the education and application. This video is all about what happens after the policy is issued, how clients access capital, how they deploy it, and how they begin using their policies like a personal banking system. Let's get into it. Where does the money come from? So let's start with the most common questions that we hear. Where does the money actually come from when a client takes a loan? Most people assume they're borrowing from their death benefit. They're not. What they're actually doing is borrowing against the cash value of their policy. This is a collateralized loan. The cash value is a living benefit that grows inside the contract over time, and it's that cash value that becomes a client's reservoir of capital. Here's the breakdown. Every time a premium is paid, part of it covers the cost of insurance, which is the base, and the rest, especially the part allocated to paid up additions, PUAs, goes directly towards building guaranteed cash value. In the early years, this value accumulates slowly, but with proper design, especially when funded aggressively, it becomes a high-performing liquid pool of capital. Now, there are two ways clients typically capitalize their policies. Number one, which is my favorite, especially for those that are utilizing these policies very early for policy loans, is front loading. They fund heavily in the first 4 to 5 years, or they do an LPUA, which is level paid up addition, and they front load their policy 6, 7 figures, sometimes up front, and then having access to those funds 30, 60, 90 days later. So essentially what happens is they're maxing out their MEC limits to immediately to build large available cash value reserves. The second option is if you don't have these large lump sums up front is slow building. This is what I did for my personal policy is over time, clients commit to consistent premiums and allow compounding to do the heavy lifting. Either approach works, but in both cases, the client can only borrow against what they've already put into the policy. For example, if a client has paid $50,000 in total premiums over 3 years, and after internal costs, their cash value is $40,000, that is their available loan base. They're not pulling money out of thin air. They're using a collateralized loan from the insurance company using their own cash as security. So you're leveraging against the cash that you've put into the policy that's built as cash value. And the best part, their full cash value continues growing uninterrupted, even when the borrowed funds are being used elsewhere. That's the foundation of infinite banking. Scenario number 1. Let's look at the first real-world application, debt recapture. This is one of the most accessible ways for a client to start using their policy. Imagine a client has $25,000 in high interest credit card debt being charged 18 to 22, sometimes 29% interest by third-party lenders. Here's how we would reframe what they're doing to be able to pay off that debt. Number 1, the client takes a policy loan from $25,000 from their whole life contract. Of course, you'd have to have that money, but you're going to take a policy loan from your contract. They use that to pay the money off their credit cards in full, eliminating the compounding interest that they were paying someone else. Those pesky credit cards, 29, 30%, they start to stack up in interest every single month, especially on those high interest rate cards and if you have a high balance. They then begin repaying their policy loan on their own terms at their own pace. Because it's not a structured loan, you can pay this loan back at your own pace. There's no mandatory payments, no credit impact, no repayment penalties. Now, instead of sending money to Visa, Discover, Chase, they're paying it back to their own system. Even while they're repaying the loan, their full cash value is still earning interest dividends as if the loan never happened. So this is how we recycle capital, eliminate bad debt, and build stronger financial positioning all at once. Scenario number 2, real estate leverage. Now let's go bigger and look at how clients can use their policy to acquire cash flowing assets. This is one of my favorite use cases when it comes to infinite banking. Let's say a client wants to purchase a rental property worth $400,000. They need $80,000 for the 20% down payment. They could pull that from a savings account or liquidate investments, but that creates a taxable event and interrupts compounding. Instead, they access $80,000 from their policy's cash value via a policy loan. No taxes, no capital gains, no approval process. They close on the property. It starts producing rental income immediately. But here's the magic of everything. Their 80,000 never left the policy. It's still there. It's still compounding. At the same time, they're earning income and equity from the real estate. $1 is doing two jobs at once. This is what we call dual compounding. It's a core wealth building principle used by the affluent for generations. So you're utilizing the policy to generate an accruing asset, which is a cash flowing rental property. On one side, you're earning with the real estate. On the other side, you're going to be earning inside of the cash value policy and paying yourself back the interest. Business capital and emergency liquidity. Now let's bring it even closer to home, because this is where these use cases really hit the heart. Imagine your client is a small business owner. They hit a cash flow crunch, or maybe a vendor opportunity arises that requires quick capital. So they have something that they need to have capital quick, and they want to act on it fast. In the traditional world, they'd have to go to the bank, get approvals, maybe sign a personal guarantee, wait 7-10 days, maybe even more for funding. But with a properly structured whole life policy, they own the entire system. They don't have to ask anyone for permission or forgiveness. So they request a loan. Funds are wired directly to their account, often within 3 to 5 business days. There's no credit check, no penalties, no required payment structure. It's fast, flexible liquidity in the client's control. And this just isn't for opportunity. Just last week, I had a client call me and said that they were in a dire emergency situation and they needed to know how much access they had to their cash value. I was proud to let them know that they almost had 91% access to how much they've put into the policy over the course of 9 months. This is unheard of in cash value policies. So these policies can be used for emergency access too, for medical bills, job loss, family needs. The policy becomes their safety net without needing to rely on traditional banks or government programs. How loans and repayment works. So let's break down how exactly these loans work under the hood. Let's pop the hood here for a second. When a client borrows from their policy, the insurance company loans them funds from the general account. They place a lien on the client's cash value as collateral, but the cash value stays fully intact and continues to earn interest and dividends. Loan interest accrues typically around 4, 5, 6%, depending on the carrier, until the loan is repaid. Now, here's the key. Repayment is fully optional. So it's not a structured loan, but at Infant Financial, we recommend treating it like an actual bank. So if you were your own bank, you wouldn't just not repay yourself back, right? You'd want to continue to repay yourself back on the money that you've lended yourself, like a real bank. So clients should repay their policy loans with purpose. Why? Because it restores their available loan base. It keeps the system healthy and repeatable. It creates a habit of disciplined cash flow management. And this isn't technically free money, okay? You're getting loaned the money. You're collateralizing your loan to earn it in 2 different places. So you don't want to have that continue to accrue interest and have it cost you more than the opportunity that you're using it for. It's strategic liquidity. And with the right repayment plan, clients can keep their system running smoothly for life. Let's address some common objections. Let's deep dive into some that you might encounter when presenting infinite banking. Objection number 1 is whole life insurance is too expensive. You're going to see the writing on the wall everywhere. So this usually comes from a misunderstanding or listening to Dave Ramsey, right? We're not buying insurance. We're building a tax-advantaged liquid asset that the client owns and controls. Objection number 2, it sounds too good to be true. There's no smoke screens or mirrors here. This is a conservative contract-based strategy that's been used by banks, corporations, and wealthy families for over 100 years. If you look at the asset class, the tier 1 asset class of banks, you'd be surprised of where they put about 35% of their funds. It's whole life insurance. Objection number 3, why not just use a HELOC or credit card? Well, because policy loans are guaranteed, private, and don't depend on interest rates, market conditions, or bank approvals. It's not just about the rate, though. It's ultimately about the control, long-term history, private, not exposed to creditors, liens, or judgments, and all the other foundational principles that are inside of an infinite banking policy. Finally, let's zoom out to the bigger picture. Now, this strategy isn't just about using cash value to buy cars or pay off credit cards. It's about opt-out financial engineering, which is creating a multi-generational system that lives outside Wall Street and traditional banks. So you're taking back control, a centralized family banking structure for yourself. Here's what we can help clients build. Policies on children and grandchildren. Imagine that. This system can be used for multi-generational wealth. Trust-owned policies for estate planning. So it's called TOLI, trust-owned life insurance. Intergenerational banking systems where capital moves seamlessly from one generation to the next. So you're not exposing it to probate or taxes or somebody else getting a hold of the money or the funds. This isn't about rate of return, it's about control. Control over liquidity, control over taxes, control over timing, access, and legacy. This is how families build lasting financial ecosystems that span for decades. You now have the full blueprint. You understand the guarantees and designs of participating whole life. You know how to fund a policy for maximum efficiency. And now you've seen how infinite banking works in the real world for debt, real estate, business, emergency, and generational wealth. This is the difference between being an agent who sells life insurance and becoming a financial strategist who helps clients rewrite their financial story. So what's next? Keep studying, be a student, be a sponge, run illustrations, have strategy calls, share use cases, learn, lean into this movement, because infinite banking isn't just a sales concept. It's a philosophy of control, stewardship, and long-term financial independence. Let's make a pact to build something bigger than policies. We're not just salespeople peddling products. Let's build a financial future for our clients. One client, one conversation, one policy at a time. My name is Josh Morin. I'm honored and privileged to be able to deliver this introductory series on infinite banking. Own the system, become the bank. We'll see you soon.